Good afternoon, everyone. The post-lunch session is usually the most difficult one because people are not really paying too much attention to the panel and trying to, stay awake. But we'll try and keep this as lively as possible, given that it's a session on how you're managing, economic challenges in insurance. I have with me a panel of CFOs and financial wizards here, and a professor also who will give us some takeaways on how you can manage economic challenges in insurance. Now, the insurance industry is one that is, fraught with risk. The whole thing about insurance is, of course, covering risk. Underwriting is a big challenge in the insurance industry, and I just take this question quickly to the CFOs here because you've got to, keep a substantial outlay for your underwriting risk. So, how do you manage that? Starting with Dhiren.
Good afternoon. It's a good question from the perspective that most people look at risk as one pooled element. But when you look at life insurance, there are multiple risks that come to bear. One is there is persistency risk from our perspective and also from the customer's perspective. What is persistency risk? Essentially, the policy does not continue till its life. In that instance, while you may think about the fact that it hurts the company and its financials, at the same time, it also hurts the customer's goals that they were saving towards. So one obviously has to take that into account when you look at risk. The bigger element is around mortality risk. And this is where things start to step up really level. Most people seem to think that it is not really a large element. But I don't know if you guys have thought about it. 1 rupee can buy you 400 rupees of cover. And therefore, the kind of leverage that you have is extremely large. That's another element of area that we have to pay attention to. And of course, then you have to look at expense risk along the way as well. How do you manage this? Keeping a constant eye on it is extremely important. And you can obviously look at ways and means by which you can lay off risk with the help of reinsurers and others. But by and large, having a close eye on risk is an extremely important element for all of us.
Okay. In the general insurance space, Jiten.
Good afternoon, everyone. I think general insurance is a little different from life. I think if I look at motor, I think the key to is granular data. When we talk about granular data, we get into motor aspects into geography and make, model, etc. And then you have historical data of the last 10 years which says which variant, which geography, under which segment actually gives you the losses which are higher, lower, etc. And then you write businesses into the areas which you feel are profitable. And that's the key to it. So the very nth level of data is the key. And the same happens for health, same for the other lines of businesses. And it's a very predictable kind of model where, a particular variant of a car or a bike or a scooter can be predicted to the degree of plus minus 5% to saying this would end up at this loss ratio. And that is the segment, the choice of the segment becomes the key. And that is the variant that you write in writing and picking up the right kind of business, depending on your strategy as a business. Okay. And that is where you make all the money.
I'll come back to you on that because there's further discussion we can have on that. I want to just go to Prasanna. In the insurance broking space, how do you look at risk when you are selling insurance to a customer?
Okay, so obviously broking is trying to bridge the gap between an insurance company and a customer. So I always try and delineate on or bringing the equilibrium a little more straight in terms of trying to bridge everybody to be at the same parlance. So one of the critical aspects which needs to be considered right now, which we are also seeing for, or I'll say in the go forward basis, especially in the global market environment, let's say if you look at Lloyd's market and all, there's a lot of automation and digitalization which is coming backed by data analytics and sophisticated tools which will help in categorizing how you need to predict those exposures, assess them, and try and manage or deliver an outcome on those basis. The flip of it is there is some bit of discrimination which could happen because of those AI-related tools. But at the end of the day, that also brings in a lot of discipline in terms of both underwriting and from customers' emergence of trying to be a little more sane.
Okay. Viswanathan, if I have to come to you, you've heard the different perspectives of how they look at risk, and like Jiten was saying, it's an asset class, this vehicle, this type of risk, all that. But is that fair to generalize categorically like that in the insurance space? That this is a risky population, this is a risky asset?
See, as far as it's concerned, the more data you have, the better it is, right? I mean, one is about looking at the asset. Also, if need be, as much data we can get, let's say if we can also look at, let's say, driver behavior, which we were talking, behind stage. The more data you have, the more refined we can get with our calculations. Because at the end of the day, the risk management boils down to two things. One is the pricing. How well you price for the expected risk, and for the unexpected risk, how do you manage with the capital? I mean, how much are you shoring up your capital? And pricing, we can improve, the more granular we can go, we can get more competitive with the pricing rather than going with a flat pricing. I think the challenge also comes in as, because standard products, I think it's, while industry is evolving, the other kind of products where it could get a little tricky, for example, a cybersecurity insurance. How do you price risk there? I mean, you can look at your ISO 27001 and SOC 2, etc. But what's the actual risk that can figure out? I mean, those are areas where I think it's a much bigger challenge in terms of managing the risk. So in a nutshell, yes, the more refined the data, the better it is, right? Going model-specific, model and driver-specific, etc. But there are going to be unknowns in certain products, which is going to be pretty challenging.
Okay. The other thing, with climate change becoming a reality now, we've seen the spate of floods and earthquakes and all that increasing. So is that a major economic challenge now, especially in the general insurance space, Jiten?
Definitely, yes. I mean,
And how
climate change is a reality. We all know, we all working towards it, and again, refining our models. The good part about general insurance is quite a significant chunk of your book is 1 year. So, all these one way or the other get factored into the pricing. I mean, some amount of floods and NatCat actually get. The other, in the long-term book, definitely you keep some amount in reserves, expecting, and these models again are becoming more and more, granular and more refined to factor all these NatCat events, so that pricing of the products at the same time reserving takes care of what needs to be there in the books to represent and withstand the shock of these. If you look at global reinsurance companies, etc., again, the entire spread of their risk could be across the world, such that, a general insurance company will reinsure a significant segment, and that will be for them a risk management technique for all this. And for a reinsurance company, it will be global geographies to ensure the entire risks gets mitigated through, diversification as such.
Okay. Prasanna, have you seen any change in the kind of pricing, especially after any natural calamity? For instance, now, Chennai, almost every alternate year there's a flood, right? And then there's a huge amount of claims happening in Chennai, right? So, and now it's known that in November, December, there might be heavy rain and floods in Chennai. So, have you seen a change in the approach by insurance companies to insuring in Chennai?
In the current market environment, not yet, but I can probably speak a little more from the upcoming year standpoint. If you look at the global market environment, the NatCat exposures for California, Miami, Florida is absolutely uninsurable. So before we even get to that level, it is important there are certain correction in rates. I think that should also be supplemented by differentiating good risk management versus bad risk management, trying to analyze where your potential risks are based out of, whether you have your manufacturing facility or you're having your oil and gas storage facility in a high risk area, and what you need to look at from a risk management standpoint, which will try and determine what kind of rates you're going to get. And then as an industry, there's some work which we need to do in terms of analyzing that, assessing it, and differentiating and providing rates. Not now, but it's just the next few quarters to go ahead.
Viswanathan, what's your perspective on this in terms of natural calamities increasing and the kind of coverage that's needed?
I mean, I'm looking at it from two perspectives. One is, of course, from a pricing perspective, but the other also from a opportunity perspective, right? Because is it likely to make more people now take general insurance, right? Opt for general insurance because they do look at it. One of the areas I'm not, because anecdotally, yes, natural calamities is a, we can easily say that, that's going to impact our pricing and other things. One thing I have not yet looked at is in terms of how has the claim ratios or, has gone up, right, over a period of time. And can we correlate to natural calamities? That I haven't looked at, so I'm not in the best position to answer whether there's going to be actual financial impact or is it just all anecdotal talks and maybe not reflecting on the ground. I'm not sure. But I also see opportunities because, maybe people could look at, it's maybe easier to sell general insurance product.
Right. A little while ago, we were talking about how there were spikes in, insurance buying during COVID and things like that. Right. Similarly, with natural calamities, now in areas that are prone to calamities, have you seen, at least in general insurance, the number of, products increasing, the buying?
So not with the calamities. I think COVID was the period where actually health insurance saw a huge spike, but not with this kind of calamities as such. Because again, it's in the areas which are prone to these calamities, are very, very isolated places. But it's still the amount of impact and the change in premiums is still to come effect. It does not directly correlate, but slowly and steadily, I think we'll get there.
Right. And I think the same in life insurance as well.
Yeah, so we had seen a big spike in
COVID.
Yeah, during COVID, we had seen obviously a spike in claims. We've also seen a spike in new demand for term insurance plans. Obviously, as you point out, CAT issues do come up, but then the fact is, because these are long-term contracts, mortality moves extremely slowly. You are in a position to adjust and move on. So there is a little bit of buffer that's built in along the way. Unlike, of course, for general, where there's a spike that you can see every other year, but typically in life, mortality rates move quite slowly.
Okay, but sticking with life, our healthcare has improved, our longevity is increasing now. So now you have an increasing aging population in India. And there are many of these endowment plans which, now there's a payout which is happening. So how do you factor in that?
No, you rightly put it. The general narrative across the world is India is a young country. I don't know if you know this, a little under 10% is 60 years and above in India. And that's clearly the target market when you want to create annuity plans. Fundamentally, you step back to 91, that's when liberalization happened. Those are the folks who are now moving into the retired phase. That's when the money got created. These are the folks who now have something that they can actually set out through an annuity and ensure that through their working lives, post their working lives, they actually have some sort of income that comes on a regular basis. And that's the need at this point. Because as you rightly put, with increasing longevity, that is a risk that they should ideally be palming off to an insurance company. That is not a risk you should be taking. So from our perspective, from the company's perspective, you look at both sides. You look at the risk of dying early, which is what you look at from a term plan. You also take off the risk of living too long from a customer's aspect, and you put that in the insurance company's pool. So I can pool the entire risk and ensure that you're getting a decent enough return on that. Now, the biggest thing that we're now trying to figure out is, rather than just the state plans that we have, which are basically flat rates that you get every year, can we look at some sort of variable annuities, which are linked to inflation? A lot of ideas are now coming through because this market is now growing. In fact, in another 20 to 25 years, the 8-9% that we have as 60 years and above could very well grow to 20. Yeah. The market suddenly explodes. And with all of those accumulation products that we've had, which is the NPS and others, as they now start come to fruition and the maturity phase, suddenly there's a lot of opportunity for us to be able to provide plans there.
Right. And it's all, in the insurance industry, it's all about, striking a balance. You're investing somewhere, getting the returns from there. But of late, we've seen a very low interest rate regime across different geographies of them, not just India. India also we might have another rate cut, hopefully, on the customer side at least. But how do you, when you have low interest rates, how do you balance the, you know, how do you deal with your reduced investment returns?
Oh, good point. Our fundamental philosophy is don't take on risks that you can't handle. Interest rate risk is best managed by a bank and not an insurance company. Right? So in such instances, what you try and do are create hedging instruments and take use of that, such that you take that risk off your balance sheet. Mortality risk we will take on. Interest risk we don't take on. We make sure that we've got instruments that are available in the market, and the entire environment has been quite supportive in creating these instruments, which is why you've seen this entire growth come through. So at this point, when you look at rates in the market, they're pretty much at their high. But as things start to move, you're taking the risk off through these instruments. Right? And what that does is, whatever I have sold at this point is locked in at a particular rate. Of course, from a customer's perspective, you can have an asset allocation balance. You can have some portion sitting in debt, some portion in equity. And that's where some of our unit-linked plans play a great deal, because you can switch out between these schemes and then ensure that you've got the right type of instrument to back you.
Right. And Jiten, your perspective on this?
I think it's a little tricky when it comes to general insurance, because if you look at most of the general insurance companies making money, it's coming from investment income. With investment income going down, it might hit the profits of most of the companies. Again, we're getting a lot of money upfront on this entire insurance piece, and that's where we're holding on to that money and making returns from investments. I think with investment rates coming down, the rate of return on investments coming down, what will happen, it will bring a lot of discipline in underwriting. And then the industry has to move to a core getting below 100. So your combined ratio has to come down before 100 or below 100 to make money. So currently, where we're having a lot of leverage from investment and making money on investment income, your core is somewhere around 100 plus, and still the insurance companies are making money. But I think as the industry matures over the period of time, this combined ratio has to come down and make money from underwriting. So that is a change. As soon as, so currently, many insurance companies will be pricing in this investment income while selling a product. Once that comes down, your underwriting disciplines, your loss ratios have to come down, and that will bring in the money. So that is a shift which needs to happen. And I think as we see the investment income going down, this shift will happen, and the insurance companies will then start making money on underwriting as such.
Okay. But what about in healthcare specifically? Healthcare costs, on the other hand, are rising. So there, how do you balance out that?
The healthcare, you say?
Yeah, healthcare.
So healthcare, that gets priced in. So it's as I said, our business is more a one-year business. So as soon as the prices go up, of course, on healthcare, on motor costs, inflation, etc., most of it is factored in pricing. But that gets corrected over a 2 or 3 year period time frame, and then products get priced accordingly, and that gets affected. But importantly, when you get 100 rupees, you make sure you make money on those 100 by paying out, say, including OPEX, to around 97, 98, and then make 2 to 3 rupees on that, rather than depending on investment income. And that's a shift that will take place once your investment income will come down.
Right. Viswanathan, how do you see this low interest rate regime playing out for insurance companies?
So because interest rate is a very key variable in insurance, right? So there are 2-3 perspectives that I look at. One is from a accounting standpoint, and because one of the obvious issues we have in accounting is that financial accounting versus an economic accounting, right? Because where lower interest rate is going to benefit, especially for established insurance firms who already have a sizable book, it can positively impact your embedded value. That's positive for you, right? That is one thing that's going to be helping you. Your fixed income portfolio is going to be, in economic terms, in fair value terms, it's going to be more worthy. But from an accounting perspective, of course, when you're following amortized cost accounting, especially on your non-linked products, that's not going to reflect there. So one is in terms of, I'm not talking from a sales perspective, but in terms of how it reflects in your books, right? There is actually, it's positive in a way, because you could see your fair value going up in terms of your asset. As far as your Risk part is concerned, I think if you have done a proper planning in terms of your cash flows and, you know, cash flow matching or a duration matching, the risk part is taken care of, you know, as Dhiren mentioned, you know, that's a risk that they in any case mitigate, that interest rate risk. One more aspect where I'm looking at is, I mean, of course, I have a separate pointer on whether interest rate is really low right now, because not necessarily, it's not currently as low as what it was earlier, right, globally as well as in India. But one another thing I see when interest rate goes down is, you know, from a guaranteed fixed income products from a sales perspective, I'm looking at it, you know. Today, if you're going to sell a guaranteed fixed income product at 5.5% IRR, somebody might, because as a retail buyer, I'm going to compare it to the bank interest rate. The minimum I would do is compare with the bank interest rate. That's going to not look very appealing to me. If interest rate goes to 5% or 6%, at 5.5% would start appealing to me, right? So there are positives to also take care, and I think, therefore, I don't necessarily see interest rate as a challenge as such, the interest rates going down, as long as it's taken care. And at the end of the day, one more thing we need to keep in mind is the interest rates, it's not a short-term interest rate that alone matters to us, right? We also need to take into consideration how the forward curve looks and what we think of when you're talking about pricing the, especially life insurance products, because we are not going to look at my 1-year rate alone if I'm going to pay a 30-year, you know, looking at a policy like that. Therefore, as long as the company is managing it, you know, from an interest rate perspective, I don't see it as a risk as such.
Okay, okay. Prasanna, a slightly different question for you. You know, of late we've seen this frenzy in the equity market, in the capital markets, and, you know, retail investors saying like, I'm getting, since staying with interest rates, if I was to look at returns, right? Even the RBI governor earlier at our previous BFSI summit said like, you know, there's not enough money coming into banks. Similarly, I guess earlier insurance was also sold as an investment product and, you know, with return on it. But now most of that money is going directly into, you know, the capital markets, into equity markets. Do you see that as a challenge there for insurance?
See, not really. The growth and the opportunity and the future penetration in the insurance industry has a huge upside. So I would say 10 years back, I've been taught this to continue my career in insurance. Capital markets are there, bank is here, insurance is here. So the probability of growth and the opportunity is always huge. The level of investment attraction in insurance, not only in India, globally, is one of the most lucrative ones, which is coming from pension funds, institutional investors, anywhere, right? My fellow colleague, my fellow panelist is a listed firm. He knows the amount of institutional investors who would want to pump in funds into his firms. So there is a lot of opportunity of investments which is pouring in. Capital investments obviously is there, but it's all about where the potential growth is. It's a cyclic phenomena, but the return on investment on insurance from a valuation standpoint and the growth standpoint would be much more empowered than investments in other areas is what I would look at.
Okay. And now to, you know, take this to the future, you know, the technology question is always there. We have AI coming in, new technology, new insurance players coming in with different technology as well to be able to quickly sell. Do you see that as a challenge? Dhiren, if I have to start with you.
No, I see it as an opportunity. Quite frankly, the way we see this is that insurance always looked like a boring company, but under the hood, there's a lot that can get done. Because end of the day, whatever you're providing as a product is backed up by solid math. And then whatever you can do to be able to eke out a little bit gives you a lot of leverage. Technology, for instance, is been one of the focus areas for us for a long time. Why? Because it gives a better value to customer, gives me better cost efficiency, and therefore I can drive prices down. Where do all of these new companies and new insurance techs that come in? They allow you to give you access to customers. We've always had this challenge of taking the product of the customer that's been the most expensive part of it. If I can reduce cost of access, that creates a lot of leverage for us. That's in terms of sales. The second bit is in terms of risk that we spoke of earlier as well. How do you control? Because as you're now going out, you're trying to get more sets of customers in. What are the tools that you can apply that make sure that you're getting the right set of customers in and keeping the worst lot out? So you've got a lot of models now that we deploy at the onboarding stage in terms of risk, in terms of persistency, which basically take off that small 1-2% off. You don't spend too much time on those, but make sure that the rest of the pool gets a far better experience. And the third element around this is once you've got a customer in, you know more about the customer. What can you do to be able to upsell and provide the next best product? So there are various facets to this, and all of them can actually get explored in much greater detail.
Right. I have a few minutes left. If anyone has a question, just raise your hand. We'll just come to you. Before that, I want to get Jiten's perspective also on, the use of technology now, especially for legacy companies. Especially for legacy companies, how you've adapted legacy companies. Yeah.
I think Dhiren picked it up brilliantly. I think I echo everything. That's one, it's a great opportunity. Of course, cost is a big advantage. I think customer service is another big. I think the one that I want to add to Dhiren is that the products that will undergo a significant change, which is much more customer focused again. For example, pay as you drive is one of the products which was impossible 5-10 years back. Today, you can have driving behaviors. You can have a car getting used and getting paid. There's insurance companies abroad which are saying, you go for a trek, take a day insurance. Before you start a trek, put it online, take a trek. So those are the kind of products you will see innovations coming in, a lot of new products. And as he said, for the companies which are there from a longer period of time, have these products available, know customer behavior well, know the demand well, and will be in a much better position to tap that market. So if somebody has health already, it's very easy for him to take another trek insurance. Somebody has car, can move that insurance to say, I don't drive it on weekends, I will take a per day basis. Those are the kind of changes that will come in. And that is where we are also banking on getting innovative products out and say, this is the market I want to be into. So there are a lot of changes happening also when it comes to mobile insurance or, now expensive watches, expensive bikes coming into the country. So these are all changes that technology can help us bridge the gap now. And that is the area of focus that can move right now from traditional products to all these new products and integrating direct end to end. So you go buy a bicycle in a shop, that, as you said, we were talking is you have a bill and you have to just tick mark and say insurance and it gets integrated into my system and say, right, I have the tie-up with him. You get insured, no worry, it gets integrated into my system. Yeah. Works phenomenally well.
Right. Can we get the question? Just introduce yourself and question.
Can you hear me?
Yeah.
My name is Anant Thatte. I'm doing something early prototyping on the verification side for across sectors. We'll go from finance and insurance to healthcare also. So the first thing is that was wonderful to hear you said, you'll manage mortality but hedge away the interest rates. Beautiful. I can quote you on that someday if you don't mind. And a question from the session title, managing economic challenges in insurance. Are you offering insurance against economic challenges? That's just a question for all of you. And then my real question is about verification. I'm doing something, like I said, on verification on these sites. How does insurance today in India, being a regulated industry, must be more structured? That's why I'm asking you. Or I'll have to keep silent until I have a product ready. But how are you handling verification? Is it once a year, chappa maar diya, kar denge yaar, that kind of stuff, or is it happening dynamically?
Yeah, so let me pick that up. See, we do a lot of verification when the customer is getting onboarded. And one of the thought process that we're working with is, if the environment or the ecosystem knows something about the customer, I don't want to ask him about it or her about it. Right? So what the ecosystem does not know, I should be able to ask that. So verification, for instance, is one element. If the customer says, I am so and so, I need to verify that. And what we are seeing now is the Indian ecosystem actually is evolving at a very, very rapid pace, supported by the government databases. A lot of the integration is coming through where you are able to verify. Verification in India is so much easier today than before. Aadhaar, PAN, CKYC, so many of options available. It's very easy to get that done. Okay. Right? If I look at the entire insurance buying process, the most challenging part is income, not medical. People will go and get the medical done. Income is the most difficult element. But with the integration of all of the databases, now with the account aggregators in place, information on income comes to that much smoother as well. Right? So a lot of work has happened, and I believe a lot more work will happen. And India will, I think, at some point leapfrog most of the other nations, just as we've done in the mobile space.
Thank you. And anybody, I'm happy to hear
Anyone
from
want to take
anybody.
up ensuring economic challenges?
Well, the professor should. Thank you.
Thank you so much. Yeah. Kumar has one question. Quick question, Kumar. Yeah.
Since there's so much money sitting on the stage, I can't help as a journalist to ask you this. For whatever has been mentioned by way of the regulator in terms of the changes made and all of that, what was occupying your mind space, say, 5 years ago, compared to what is occupying now as a priority? And going forward, what do you say? So that we get a perspective of the money in this issue.
So let me start off saying that it's not our money. We're custodians of public money.
I was coming to that as well.
5-6 years back, I think we were all grappling with the opportunity. Growth was evident in India at that time, but we were trying to figure out how to be able to tap that growth. As we stand today, I think the opportunity is well established in savings, in protection, and in annuity. And the opportunity is very well established. A lot of these are multi-decadal opportunities. The challenge for us is to be able to take it smoothly to the customer. Evincing interest, I think, has become much easier. Work on that has to continue. But once the customer says, I want to buy, how smoothly can you bring the customer on board? Which are the elements that I spoke of. To buy a plan, for instance, you need 4 things. You need to know who the customer is. You need to know how wealthy or how worthy he is from a financial perspective. How healthy is the customer? And can he make the payment? Payment ecosystem is the best in the world. KYC we just discussed. Medical, if the customer wants to do it, she will do it. Income becomes the most critical element. And in a country as wide as and diverse as India, income declarations are the ones that you need to do additional verification on. So if you're able to leverage the ecosystems to get this done, then you are in a position to be able to deliver a plan that much smoother.
Yeah. Right. Prasanna, you just want to add to that, or we can end? I think we're out of time almost. So.
You have a question.
You had a quick question? Okay, very quick question because we're
Sorry. Hello. Yeah. Just one question I had to the panelist. Any of you can answer it. See, we know that it's largely predicted that interest rates would fall in the future. Now, given this backdrop, how would an insurance company ensure that there is no asset liability mismatches happening in the future? Because that's why customers put their money, so we want to ensure that customers are protected from this liability and asset mismatch, which happens.
See, I think it's a more life problem than a general problem. So I'll let Dhiren only answer because we are, as I said, it's more an investment income. So it doesn't affect our asset liability management from an interest rate. It'll affect our income. But from a life perspective, I'm sure there are plenty much to handle on interest rates.
So broadly 3 sets of plans. If you've got a unit-linked plan that's investing in the market, you're going up and going down as the market goes up, both equity and debt. The guaranteed portion is one that one should be worried about. And for that, you look to an insurance company to see whether they're in a position to hive off and get a hedging program in place. We spoke about a variety of instruments in the market at this point, which allowed you to take off the interest rate risk, because that is not a risk that insurance companies are good at. Banks are better at it. So that's one of the focus areas that you should be looking at as an investor, whether this particular company runs a program which allows them to hive off the interest rate risk.
okay. And I think with that, we're out of time. We can take these questions offline. Thank you so much, Dhiren, Jiten, Vishwanath, and Prasanna for joining me on this panel. Thank you.